Suppose you buy a bank. You now own one of the few businesses that can create new deposit money simply by approving a loan. The borrower sees a balance that did not exist a moment earlier. Your bank records an asset and begins earning interest. But every new deposit is also a promise. Customers expect their money to be available on demand, while many of the assets behind that promise will not be repaid for years. If too many people ask at once, a profitable bank can run out of usable cash before most of its borrowers miss a single payment. That is banking's central contradiction. A bank can create deposit money. It cannot create unlimited capital, liquidity, or trust. The difference between those things is where fortunes are made and where banks die. So if you want to buy a bank, the most important asset is not the vault, the branches, or even the loan portfolio. It is the legal and public trust that allows a thin layer of owner capital to support a much larger financial machine. You cannot simply register a company, rent an office, and begin accepting insured deposits. In the United States, a national bank needs a charter from the Office of the Comptroller of the Currency. A state bank needs approval from its state chartering authority. A new institution that wants federal deposit insurance must also apply to the Federal Deposit Insurance Corporation. Depending on its structure, the Federal Reserve may be involved as well. The regulators examine the business plan, the market, the proposed directors, the management team, the sources of capital, the technology, the lending strategy, and the systems designed to prevent fraud and money laundering. They are not only deciding whether your idea can make money, they are deciding whether the public should be allowed to trust it with deposits. There is no universal rule saying every new American bank must begin with exactly $20 million. The required amount depends on the bank you are proposing, but the Federal Deposit Insurance Corporation normally expects a new bank to maintain a Tier 1 leverage ratio of at least 8% during its first 3 years. That means a business plan built around $250 million in assets could require at least $20 million of Tier 1 capital. The requirement could be higher if the model is concentrated, unusual, or especially risky. The owners are also expected to fund the institution well enough that it will not depend on another emergency capital raise during those first years. This explains why buying an existing bank can look more attractive than building one. An operating bank already has a charter, insured deposits, employees, customers, payment connections, compliance systems, and a history that regulators can examine. But buying it does not allow you to avoid regulatory approval, and you inherit everything hidden inside its balance sheet: weak loans, expensive deposits, outdated software, unresolved compliance problems, and securities that may be worth far less than their accounting value. What you are purchasing is not a license to print free money. You are purchasing a highly leveraged balance sheet and permission to manage it. To see how that balance sheet works, imagine your bank approves a $100,000 business loan. It does not normally carry $100,000 in banknotes from the vault to the borrower. It records a new loan as an asset and credits the borrower's account with a new deposit of the same amount. The loan is money owed to the bank. The deposit is money the bank owes to the customer. At that moment, new deposit money has been created. When the borrower repays the principal, that deposit money is extinguished. The bank keeps the interest and fees as revenue, but the principal is not a magical profit. It closes the matching part of the balance sheet. This does not mean a bank can create unlimited money. The borrower may transfer the new deposit to someone at another bank. Your bank must then settle that payment using cash, reserves, or funding it can obtain from the financial system. It must hold enough capital to absorb losses, enough liquidity to meet withdrawals, and enough reliable funding to support its assets. Regulators also limit concentrations and examine whether the loans are being underwritten responsibly. The formal reserve requirement on certain American deposit accounts has been 0 since March of 2020. But a 0 reserve requirement is not the same as 0 constraints. Capital rules limit the losses a bank can survive. Liquidity rules limit how long it can survive a rush for the exits. And the market limits how cheaply it can attract money when customers have better alternatives. The central business is a spread. A bank pays for funding and earns a higher return on loans and securities. The difference, measured relative to its earning assets, is its net interest margin. In the first quarter of 2026, the average net interest margin across federally insured institutions was about 3.31%. That sounds small, but a small percentage applied to a very large balance sheet can produce substantial revenue. Imagine a community bank with $300 million in assets. If its net interest margin is close to 3.3%, It may generate roughly $10 million a year in net interest income before operating expenses, credit losses, and taxes. It may also earn fees from payments, account services, card products, wealth management, loan sales, and treasury services. Then the less glamorous part arrives. Salaries, branches, cybersecurity, fraud controls, core banking software, audits, deposit insurance assessments, legal work, compliance teams, and provisions for loans that will not be repaid all consume that revenue. The American banking industry reported a return on assets of about 1.26% in the first quarter of 2026. On $300 million of assets, that ratio would translate into about $3.8 million of annualized profit. If the owners had $30 million of equity in the bank, the same result would represent a return on equity of roughly 13%. That is the attraction. Banking converts a modest return on an enormous pool of assets into a much larger return on the owner's smaller pool of capital. It is also the danger. Leverage magnifies losses in exactly the same way. If loans equal to 5% of that bank's assets become worthless, the loss is $15 million. That would consume half of the owner's $30 million in equity. Depositors may still see the same number on their phone screens, but the cushion protecting them has been cut in half. This is why the most profitable loan is not necessarily the best loan. A high interest rate usually signals that the borrower is more likely to default. The bank must price the expected loss, servicing cost, fraud risk, and capital requirement, not merely compare the loan rate with the interest paid to depositors. Credit cards demonstrate the opportunity and the problem. At the end of 2024, the average interest rate across American credit card accounts was around 21.5%. Accounts that actually incurred interest averaged roughly 22.8%. By the third quarter of 2025, total American credit card balances had reached approximately $1.2 trillion. Those rates are far above the yield on a typical mortgage or government bond. But the difference is not pure profit. Card issuers pay for rewards, fraud, servicing, marketing, funding, and defaults. Customers who pay the full balance during the grace period may generate interchange revenue, but no interest. Customers who revolve balances can be extremely profitable until unemployment rises or household finances break and charge-offs accelerate. The bank is always exchanging one risk for another. It takes deposits that may leave tomorrow and turns them into mortgages that may not be repaid for 30 years. It promises customers immediate access to money while investing much of that funding in assets that cannot be sold quickly without a loss. This mismatch is not an accident. It is one of the services a bank provides. Depositors receive liquidity. Borrowers receive time. The bank earns a spread for standing between them. But the spread works only while both sides continue to trust the bank. Silicon Valley Bank showed how quickly that trust can disappear. At the end of 2022, it had about $209 billion in assets. Its customers were heavily concentrated in technology and venture capital, and a large share of their deposits exceeded normal federal insurance limits. During the years of low interest rates, the bank invested large amounts of rapidly growing deposits in longer-term securities. When interest rates rose, the market value of those securities fell. The loss could remain unrealized while the bank held them. But depositors began using their cash, and the bank needed liquidity. On March 8, 2023, Silicon Valley Bank announced that it had sold securities at a loss of about $1.8 billion and planned to raise new capital. Instead of restoring confidence, the announcement revealed how vulnerable the balance sheet had become. The next day, depositors withdrew more than $40 billion. Management expected withdrawal requests for roughly $100 billion more on the following day. The bank had valuable assets, but it could not turn enough of them into cash without crystallizing losses. Regulators closed it on March 10th. The lesson is not simply that long-term bonds are dangerous. The lesson is that an asset can be safe from default and still be dangerous for a bank if it matures at the wrong time. United States government securities may repay every dollar at maturity. That does not guarantee that they can be sold today for the price the bank originally paid. It also shows why the composition of deposits matters as much as their total amount. 1 million small retail accounts protected by deposit insurance usually behave differently from a small group of large corporate accounts that can move billions with a few messages and phone taps. Recent research by the Federal Deposit Insurance Corporation into the 2023 failures found that large depositors with substantial uninsured balances were much more likely to run, while fully insured retail customers generally stayed. For a bank owner, growth can therefore be misleading. Deposits are funding, but unstable deposits are a liability that may vanish precisely when replacing them becomes most expensive. There is another cost that does not appear in a simple interest spread calculation: compliance. Banks sit at the entrance to the payment system, so they are required to understand who their customers are, monitor suspicious activity, keep records, and report warning signs. Weak controls can turn profitable transaction volume into an existential legal problem. In 2010, Wachovia entered a deferred prosecution agreement after admitting that it had failed to maintain an effective anti-money laundering program. According to the United States Department of Justice, the bank failed to monitor more than $420 billion in transactions involving Mexican currency exchange houses. The government identified $110 million in illegal narcotics proceeds laundered through the bank. Wachovia agreed to forfeit that amount and pay an additional $50 million fine. The distinction matters. The entire $420 billion was not proven drug money. It was the volume that moved through systems the bank failed to monitor effectively. The case demonstrates why compliance cannot be treated as paperwork that produces no revenue. When a bank processes payments, the fee may be small, but the legal responsibility travels with the full transaction. This is also why buying an established bank is not automatically safer than starting one. The seller may offer loyal depositors, a respected local name, and a portfolio of seasoned loans. It may also deliver years of files that were never reviewed correctly, borrowers whose collateral has fallen in value, and customers who will leave as soon as the acquisition is announced. The rational buyer begins by separating the bank into 4 questions. How durable is the funding? Retail checking accounts can be valuable because they are often stable and relatively inexpensive. Large deposits gathered through high rates or brokers can disappear quickly. How good are the assets? A loan book that reports few defaults during a boom may still contain concentrated exposure to one city, one industry, or one type of property. How sensitive is the balance sheet to interest rates? Fixed-rate assets financed by deposits that reprice immediately can destroy the margin when rates rise. Long-duration securities can create losses when liquidity is needed. And how much capital remains after the assets are marked honestly? Book value is meaningful only if the numbers underneath it reflect economic reality. The bank with the highest reported profit may be underpricing loans, delaying charge-offs, or taking interest rate risk that will not become visible until the environment changes. A slower bank with a diverse deposit base and conservative underwriting may be worth more, precisely because it appears less exciting. By the end of the first quarter of 2026, more than 4,200 federally insured banks and savings institutions held about $26 trillion in assets. Together, they earned more than $80 billion in that quarter. The industry is profitable because society continuously needs payments, credit, savings, and risk transformation. But the owner is not collecting interest on money that belongs entirely to the owner. The bank is borrowing confidence from depositors, converting it into long-term assets, and promising that everyone can have their money when they ask for it. If you buy a bank, you are buying that promise. The charter makes the promise legal. Deposit insurance makes it credible. Capital absorbs the first losses. Liquidity buys time. Compliance protects access to the financial system. Underwriting determines whether the loans ever come back. And trust keeps depositors from testing the entire structure at once. Get those pieces right, and a 3% margin on a large balance sheet can create an exceptional business. Get one of them badly wrong, and hundreds of millions of dollars in assets may not save you for a weekend. That is the real economics of owning a bank. The product is not money itself. It is confidence. Confidence that a payment will clear today, a deposit will be available tomorrow, and a promise made for 30 years can still be honored when conditions change. If this story changed the way you look at banks, subscribe and join us. Every new documentary takes a familiar business apart, follows the money, and reveals where the profit ends and the risk begins. And the next time you pass a bank, remember this: the most valuable thing inside is not the cash. It is the confidence that the bank will never have to prove every promise at the same time.